Hi, this is Michael King, and we're wrapping up our course, taking a look at all the things that you've covered and added to your financial toolkit since taking this course. Let's take a look at what the course objectives were and the learning outcomes. We wanted to learn about financial markets and financial assets and securities, how to value companies using Excel, and all the tools that you would need to do that. And look at what we've done. We've learned all of these different financial tools, including the common size financial statements and size up, how to calculate the WACC, generate a discounted cash flow valuation, use market multiples, value stocks and bonds. Your financial toolkit is now full of tools that you can use. Here's an overview of what we've covered in this course. Look how much there is you've covered and mastered. These tools will serve you as you go forwards in many different settings. You'll be able to use them to value companies, to work in the treasury of a company, to be an investment advisor, to be a portfolio manager. You just have to know which tools to use and when. You've also learned a lot of qualitative or strategic tools, the size up and how to interpret case information in order to make a decision in the face of uncertainty, how to generate forecasts, how to criticize inputs and the outputs from different valuation tools. You've become financial analysts. Using the tools from CSI Finance, you know how to do a deep forensic dive on a company. You know where to look to dig deeper in order to find out what's going on and what are the value drivers in a business, where the risks are, and what's likely to come in the years ahead. You've also started to learn how to speak that new language, finance. So many acronyms, so much jargon, so many new terms, and you understand where they come from, how to use them, what the definitions are. You'll be able to make a convincing case when talking to other people about financial markets and securities. You've learned how to break down a company by doing a financial size up, starting on the outside using an external size up that looks at the economy, the industry, the competitive landscape, and then going internally and looking at the qualitative factors such as the strategy, the management, marketing, logistics, production, and also the financial ratios that are looking at the financial strategy. You understand how to calculate those ratios and how to interpret them. So many categories of different financial ratios. The key is to look how these ratios vary for a company over time, how they vary across a company and its peers at a given point in time, and how they relate to a company's financial strategy. You understand how to use these ratios to identify outliers or areas where you need to go deeper to find out what the value drivers are. You've understood how to use ratios such as the DuPont decomposition to really look at what the drivers are for a company's profitability, whether it's its profit margin, the turnover of its assets, or the use of financial leverage. You understand how to analyze a company's working capital and how it ties up cash in the process of buying inventory, selling and having accounts receivable, as well as delaying payments to suppliers. This financial gap or working capital gap has to be managed, and you understand how to calculate it as well as how to change it to be in your company's favor. You understand how to use a pro forma forecast to understand what's coming for a company, looking at both its income statement and its balance sheet, keeping in mind that circularity that happens based on the use of debt and how that affects interest expense, as well as the cash balance of the company. You know how to use this forecast as a tool to determine how to finance the company and how the financial policies will affect its position. You know how to value any financial asset using the magic formula. It's just a question of those three inputs. What are the cash flows? When do you receive them? What discount rate will you use? This is the formula that can be used to value stocks and bonds. It can be used to value a company. It can be used to value any asset. Just remember, it's all about cash flows, timing, and discount rates. Putting it all together, we looked at how we could use the magic formula to value stocks and bonds, how the combination of stocks and bonds in a company's capital structure can be used to calculate that hurdle rate which we called the weighted average cost of capital. How this hurdle rate, or WACC, was an input to a valuation model known as the discounted cash flow model, which is based on a forecast of free cash flows to the firm. Once you have these principles in place, you can use this for valuing a company for its IPO, you can look at a merger or a takeover, and later you could look at a leverage buyout. Remember that capital structure is a trade-off between the benefits of tax shields coming from debt and the costs of financial distress. Leverage can certainly increase a company's return on equity. Too much leverage, however, can lead the WACC to rise and the valuation of the company to fall. The key is to identify that optimal amount of debt relative to equity to minimize the WACC and maximize the firm's value. You learned how to calculate the weighted average cost of capital, all the different components, whether it's debt, preferred shares, or common equity. Really, it's only about understanding the market values of each of those in proportion in the company's capital structure, the costs for each of those, which is the return expected by the holders of those securities, and adding the tax benefits for debt. Using the weighted average cost of capital, you'll be able to value companies as well as look at capital expenditures and do capital budgeting for a company. We learned that the best way to calculate the cost of equity is to use the capital asset pricing model. This model has 3 inputs. You understand how to use the government risk-free rate, a 30-year bond, as your benchmark, and then you add on to it a premium for holding stocks over bonds, which is a function of the historical equity risk premium of 4 to 6%, plus the company's non-diversifiable or systematic risk, which is measured by its beta. You know how to measure beta. You also know how to modify beta by unlevering it and relevering it as a company changes its capital structure. You also learned how to value bonds. Remember that the yield and the price of a bond with a fixed coupon move in opposite directions. How to price a bond is a question of looking at comparable bonds of other companies. Once you have a company and its credit rating, you can calculate what credit spread you need to add to that risk-free benchmark, which gives you the yield to maturity, or the return expected by investors on that bond. We also saw how to build a bottom-up intrinsic valuation of a company using a discounted cash flow model. This model pulls together many of the pieces that we've learned about. It pulls together financial ratios and common-size financial statements, which go into generating that forecast of EBIT and the other components of the free cash flow to the firm. These are cash flows that are available to pay to all capital providers, irrespective of capital structure. We saw how you discount those free cash flows to the firm using the weighted average cost of capital. We also saw how you use the terminal value as a shortcut to capture all the free cash flows that happened beyond the end of your forecast horizon. Taking the sum of the present values of those cash flows in terminal value, we get the enterprise value, which is the market value of the assets. And we saw how you can back out the value of the equity by subtracting net debt, preferred shares, and non-controlling interests. A key thing that we learned was how to use sensitivity analysis to look at how changing the assumptions in this model will affect your valuation. And that is the way that you're going to identify the key value drivers in a company's valuation. We learned about the process of taking a company public through an initial public offering. Many steps involved, many players involved, all who have different incentives. Don't forget the incentives of the company's management, their insiders, their underwriters, as well as new investors. You know to look at the prospectus to find the information needed for your valuation model. You also need to know about external market conditions and how this could influence the pricing of this new deal. IPOs tend to go up on average on the first day of trading. We saw how there could be signals that this IPO may be the exception and may actually decline. We also learned how to value an outstanding company using its market multiples of comparable companies. These are multiples such as price to earnings, EV to sales, EV to EBITDA. We're going to look at past or last 12-month multiples, as well as forward or next 12-month multiples. By choosing those comparables carefully based on their industry as well as their size, we're going to identify the companies to include calculate their multiples, and removing outliers, we can use the mean and the median to come up with a range of reasonable valuations for our company using this relative valuation approach. We did a number of case studies, and you learned the fundamental way to analyze a problem. Look at the options. Set the criteria for choosing amongst the options. Do your analysis to calculate which of those options is going to be meeting the objectives. We ran through this exercise 7 times using different companies and different industries, gaining practice in those financial tools in our toolbox. We summed up this by doing a valuation of Apple Inc. We used the same steps that we would use to value a company. We looked at its financial statements. We calculated common size financial statements and ratios. We looked at market multiples. We did a pro forma forecast. And then we calculated a discounted cash flow valuation of Apple based on what we predicted to happen in the future. You saw how this could be very sensitive to the inputs and how important it is to understand the drivers of sales and margin when doing this model. Lastly, you got experience trying this yourselves using a TSX 60 listed company. You wrote an equity analyst report that pulls together all of those different tools that you have and shows how you've mastered them. You came up with a recommendation to buy, hold, or sell that company along all of these different dimensions. This is the capstone of this course, and congratulations for this great piece of work. Congratulations. The course is over. Now what you do next is up to you. I recommend that you keep reading, you keep following financial markets. You dip your toe in the water and you invest, the bond markets as well as the equity markets. You can continue your studies by applying for UVIC's Applied Portfolio Management Program, a student-run investment fund that has $1.2 million where the students are deciding what equities and what bonds to invest. You could also consider the Chartered Financial Analyst designation, excellent designations that will help you in your careers. You can also consider a position in the financial services industry, whether it's as an investment advisor, as a portfolio manager, or a risk manager. There are a range of roles to suit everyone who's interested in these topics. Good luck with your future careers in finance, and please stay in touch.